Hello everyone, I hope you guys are doing well and studies are going in full swing. So in this video we are going to discuss about your CA final AFM May 25 RTP. In this RTP, the important questions that you should review, which are new, we have mentioned over here, which is in the descriptive sections, question number 3 from your derivatives and question number 13 from your international financial management. The last two questions are definitely theory, which you should go through for your practice, and within the MCQ based case studies, the case study number 2, which is on interest rate management, which is having a bit of variation, is also something that you can review. So these are the things that we will discuss in detail, and for the other questions we'll kind of have a quick overview on what you need to review over them. So let us do a quick roundup. It is not a very difficult or a very tricky RTP as compared to FR, which had a little more adjustments, I would say. So this is a manageable RTP. We'll kind of try to compress this and do this in the shortest possible time. So let us get started. When you look at your MCQ case study number 1, this is exactly similar to your question number 4 of risk management. One of the recent exam questions was also on similar lines. So you can review that. We'll probably discuss this later if time permits. But what we'll first focus on is your interest rate risk management, your MCQ case study number 2. So let us review this first. P Limited is going to borrow an amount of 60 crores. So B is a borrower for a period of around 3 months in the coming 6 months time from now. So 6 months later for 3 months. So ideally 6 by 9 should be your ideal for the current rate of interest is 9%, but it is likely to go up in 6 months. As a borrower, you are worried about that. And the company wants to hedge itself against a likely increase in the interest rate. Your CFO has been asked to suggest both traditional as well as modern methods to hedge the interest rate risk. Suppose the banker of P has quoted the following forward rate agreement, that is FRA, as under. So there are various things. If you need a borrowing after 6 months for a bit of 3 months, your ideal FRA is 6 by 9 FRA. So your ideal FRA is a 6 by 9 FRA. Within that, the lower rate will be the deposit rate, the higher rate will be the borrowing rate, and hence the banker over here, if they have to agree, will agree at a FRA at around 9.3%. Okay, based on the above, answer the following. Suppose if P agrees to adopt FRA method to hedge against interest rate risk, the interest rate of dash will be applicable. We believe 9.3% based on what we have interpreted the quotation. Answer is B. Suppose the actual rate of interest after 6 months happens to be 9.6%. Then the settlement amount will be. Now remember, there are two ways in which you can think. Now if you are a borrower, in order to look at this, a borrower will usually buy the FRA. Why? A borrower usually pays interest, and if I'm paying interest, I pay money for things that I buy. So usually a borrower, in terms of strategy, will buy the FRA, which means I must have bought the FRA at around 9.3%. Now I will square off, I will sell it at around 9.6%. So there's a 0.3% gain. Now this is one way if I were to mechanically review this. On the other hand, if I were to conceptually say, I will say that logically I have agreed to borrow at 9.3 when in the market I could borrow at 9.6. So I have agreed to borrow at a lower rate, and hence 0.3% will be my gain. Now this is 0.3% on what? So this is 0.3% on a borrowing of 60 crore, but this is 0.3% per annum. 9.6 minus 9.3 into 3 by 12. This is a 3-month borrowing. So this will give you, if I multiply, this is 0.05 crores or 4,50,000, but this 4,50,000 will be settled after 3 months because interest is paid after 3 months at the end of the borrowing. If I want to settle it today, this is 1 plus 0.096 into 3 by 12. That is 4,50,000 upon 1.024. That will come to around 4,33,000, I believe. 4,39,000, 453, 439. You can calculate this. 453. Now this amount is a gain for the entity, and hence this will be paid by the banker to P. So over here 439, 453 shall be paid by the banker to P. So this is the right amount and then paid by banker to P. Answer is B. Sorry, answer is C. Suppose the actual rate of interest after 6 months happens to be 8.8%, then the settlement amount would be, well, I've agreed to borrow at 9.3, but the market rate is 8.8, which means I'm agreeing to borrow at a higher rate, and hence there is a loss for P Limited of how much? 0.5%. 9.3 minus 8.8, 0.5% negative, this is a loss, into 60 crores, again into 3 by 12, upon 1 plus 0.088 into 3 by 12. So if I do this working, maybe this is 7,50,000 upon 1.022, which will come to 733,855, but this is paid by P to the banker, and as a result this is paid by P to the banker. So answer should ideally be B as in Bhavik. Okay, so then you have point 4. Now this is kind of a theory thing. Which of the following is not a modern technique to hedge interest rate risk? Futures and options have been fairly recent once exchanges have been introduced, as well as swaps. But the forward rate has been there since quite some time, and as a result the forward rate agreement, that is option number D, is to be taken as the answer over here. Okay, so this is the 4th MCQ, and you are done with your case study based MCQs. Second MCQ. Okay, then you have this new question on derivatives. I mean, it is based on questions which are there, but there are slightly different data points. So there's one particular point where there's a problem, that is point C, but other than that it is a solvable MCQ. So let us solvable question. So let us review this. Mr. X, who is a senior portfolio manager at ABC Asset Management Company, he expects to purchase a portfolio of shares in 90 days. I am going to buy the portfolio of shares after 90 days. So I'm worried that what if the price will go up? However, he is worried about the expected increase in the share prices in the coming days, and in order to hedge against this potential price increase, he decides to take position on a 90-day forward contract on the index. So this is a 90-day forward contract on the index. The index is currently trading at 2290. So this is your index current price, 2290. Assume that the continuously compounded dividend yield on the same index is 1.75% unless given otherwise it is per annum, and the risk-free rate of interest is 4.16%. You are required to determine. So over here what you have been told is, this is telling you the index is currently trading, so this must be the spot price. This must be the spot price. Now what is a justified forward price on the above contract? So over here, because there is continuously compounding involved, the formula will be F is equal to S into E raised to R minus D, that is rate of interest, minus the dividend yield, into N depending on is the number of years. If you have to take the working in months, that is months divided by 12. If you have to take it in days, that's days divided by 365. So you have to find the justified forward price on this contract. So the forward price over here would be F is equal to maybe spot, that is 2290, into E raised to R 0.0416 minus 0.0175 into, it's a 90-day contract, so 90 by 365, let us say. So if I do this working, this is 2290 into E raised to 0.0416 minus 0.0175 into 90 by 365. You get a big number, 0.005942. Okay, now this number you can calculate on your calculator, so you can see at the end of the question if that data is given. So if you see at the end of the question, you are supposed to take 365 days, and E raised to 0.005942 is 1.005960, 1.005960, and if I multiply this is 2303.65 approximately. So this is your forward price based on the data, 2303.65 approximately. Now second problem is a little theory based. The position Mr. X should take in the forward contract on the index. Now the thing is, currently you are neither long nor short, you don't have the shares, but you are going to buy the shares after 90 days. Now you are worried that what will happen if the share price increases, and hence you are trying to hedge using index. Now if your shares are increasing, usually index will also increase. So if index is likely to increase, the appropriate strategy should be you should actually go long, that is buy today at a lower price, and then later when the index increases you can later sell it, cover the deal, and as a result you can make a gain. So currently you are neither long nor short. However, later you are likely to buy, and hence if your expectation is that the price is going to increase, your portfolio shares are likely to increase, the index will also likely to increase, and hence you should ideally take a position which is long, or go, in which case you will buy the index. So over here, first case over here is your answer being, if I were to summarize, 2303.65. Second case, you are going long. Now third case is a little contentious, it is debatable, we can do it in two ways, approximately same answer, but it's a little contentious, I would say. Point C we'll do in some time. Let's look at point D first. Point D, gain or loss on the position taken. What was your position taken? Long, which means you must have bought at the theoretical price of 2303.65. If you have bought, that is your cost price. The gain or loss on the position taken if at expiration of 90 days, the index value is 2470. After 90 days, that is at expiry, the spot price and the forward price will remain the same. This is 2470. If you have originally agreed as your position to buy, that is long, at the end you will cover it by selling, that is sell it at 2470. So if I have to find a gain or loss, I'll say, well, I'd agreed to buy at 2303.65. because my original position was long, I expected the price to increase. The price actually increased and went up to 2470. So this is my selling price, and it's 2470 minus 2303.65, and your gain is 166.35. Now these three numbers are logical institutes working also tell you the same thing. The problem only comes in the third part, where there can be two possible treatments. We'll discuss what is the possibility. Okay, the gain or loss on the position taken, that is a long position taken, if after 28 days of the purchase of the contract, the index value stands at 2450. No, this is the index value. In my limited understanding, this must be the spot index value. So ideally, if I want to find a gain or loss, I would say that 28 days later, the spot index value is 2450. If nothing, that is a spot index value, it is 2450, which means if I've originally taken a position which is the long position, gain or loss on the position taken, they're clearly saying, so this was, let us say, a long position that I've taken, and if I've taken it, in my limited understanding, and I might be wrong over here, I've taken it at 2303.65. in fact the entire sum is solved like this, so that means your cost price is 2303.65. however, after 28 days I want to sell it, but after 28 days, if it was a forward for 90 days, I can't cover it in the spot market, so I'll have to take, in a way, an opposite position on a similar forward for the remaining 62 days in my understanding. So 90 days are there, 28 days have gone by, 62 days are remaining, and hence I will try to find the theoretical price based on the position after 28 days. After 28 days, I can clearly see that the spot is at 2450. So based on that, what should be your theoretical forward price? So what I've tried to do is, I've given you the solution over here, point 1, as we see, 2303.65, long, because you want to protect against price increase. Now if I look at the third case, your original position was clearly a long position at 2303.65, 28 days have gone by. If you want to kind of find a gain or loss, you will say that I will cover it by taking the opposite position, that is I will sell it, but I can't sell in the spot market. I'll have to take like a reverse forward, or the opposite position, I'll sell it short at the price prevailing after 28 days. Now I don't know what the price is after 28 days, but being a derivative, the price will also depend on the spot price today. So ideally F is equal to S into e raised to r minus d into n by 12, 2450, that is the price after 28 days, into e raised to 0.0416 minus 0.075 into 62 by 365, which is nothing but the remaining time period. and thereby you will find that theoretically the price should be 2460.05 prevailing after 28 days. Now your original contract was a buy contract, you will cover it by selling it, and hence your gain or loss will be 2460 minus 2303, there is around 156 approximately. Now Institute over here has not done this like this. Institute has done it slightly differently. Again, your answers might be approximately be the same, but that is not necessary. So what they have done is something which I find is a little difficult to get my arms around, but nevertheless, if I discuss this, what ICI has done in sub point 3, which I'm not very comfortable with, but again, my opinion matters less. So over here, what ICI has done over here is, they have said that after 28 days, what is the prevailing price? 2450. So take that. Now, ideally, it was a 90-day forward. How can you take the spot price? But nevertheless, let us say you take that 2450. That is the price at which you will cover. Okay. And when you took the contract, the price was 2290 and 28 days have gone by. So over here, you will compound and find that 28 days later, this same will be worth how much? So what they've done is unwinding in a way 2290 into unwinding for 28 days, and that will give you around 2294. 2450 minus 2294 is 155.76 or also 156, but ये मन बनाने वाला बात है मेरे हिसाब से. Again, I mean, I would be really happy if you can also share your perspective in your comments on why you think, if you think Institute's method is correct, why it is correct, and this will be really helpful for students in general. But in my opinion, doing this way is also possible. Maybe their interpretation is different. They're covering it at directly 2450, which I believe is a spot price, and then comparing it with the unwound price. Maybe they're doing this because it is a forward and not a future. But ideally, if it is a derivative derives value from the price prevailing, and hence if it is going to be settled after 62 days, in my opinion, that should be taken. But this is something which, if you have a doubt, in my opinion, it is legitimate. It's a legit doubt, because over here point 3 is not something which is very comfortably or clearly solved. So this is pertaining to case study number or question number 3. Now the other questions 4, 5, 6, 7, 8, they are exactly same or similar, just with numbers being different to materials which is there in your books you would have covered, and hence we'll probably discuss this quickly at the end. But other than that, it's not a new questions here. Another new question which I would say is there in question number 13 for AFM. So let us review that. So let us review question number 13 in AFM. A proposed foreign investment, so there will be a foreign investment, involves creating of a plant with an annual output of around 1 million units. Okay, so the output will be 1 million units, and the entire production will be exported at a selling price of $10 per unit. We don't know where the plant is located, we don't know where we are exporting, but we know that the selling price is $10 per unit. At the current rate of exchange, the dollar cost of local production equals $6 per unit, which means at the current exchange rate, if your selling price is 10, your cost is 6, then the profit is 4 per unit. This is as per the current setup, 4 per unit, and there are 1 million units, which means if I do this in million, this will be, I think, around 4 million or 40 lakhs. Now the dollar is expected to decline by 10 or 15%. Okay, the change in the local cost of production and probability of the expected level will be as follows. So if there's a decline in the value of dollars by either 0%, that is remains the same, or 10% or 15%, there will be a reduction in the local cost of production. How? We don't know, but they have clearly told that if the exchange rate changes, the cost of local production will reduce, and hence we will do it like this. It will reduce by 0.3 and 0.15. So your current cost is 6. 6 minus 0.3 will be 5.7, and an additional 0.15 will be 5.7 minus 0.15 will be 5.55 maybe. So over here, if there's a 10% fall or if there's a 15% fall, the export proceeds are the same, but the local currency cost is either falling to 5.7 or 5.55, and as a result, the profit per unit changes. This comes to what? Is it 4.3? Yes, and this is 4.5. 55. Again into 1 million units, 10 lakh units, and hence this is 43 lakhs, this is 45 lakh, 50,000. Okay. What is the probability? These are the probabilities. Now again, the plant at the current rate of exchange will have a depreciation of 1 million annually. This is at the current rate of exchange. Maybe you are converting everything back into USD and working based on USD approach. So as per USD approach, your selling price is already in USD. Whatever was the local production, you converted it back in USD and that came to either 6 or 5.7 or 5.55. So when your exchange rate was declining, your cost reduced. I'll again repeat, your dollar cost reduced. When the exchange rate was declining, your dollar cost reduced. It went from 6 to either 5.7 or 5.55. In a similar way, at the current exchange rate, depreciation is 1 million. But that is at the current exchange rate, which means maybe in the country where you are setting up the plant, you're not calculating tax, but you're calculating in the US, which means you'll have to convert everything into US dollar. Even depreciation will be converted into US dollar. If my exchange rate changes, my local currency cost changes. In a similar way, if my exchange rate changes, my depreciation in dollar will also change. Sir, how will I figure out whether depreciation in dollar will be what? I don't have the rates. Okay, logically, if your local currency cost is also a cost, if the exchange rate is changing, your cost is declining. If your local currency cost is declining, even depreciation is another cost, and hence depreciation will also decline. By how much will it decline? Well, if nothing is given, then it will decline by the same manner in which your exchange rate is changing. Like if your exchange rate is changing by 10%, your depreciation of $1 million, that is $10 lakh, will become $9 lakh. 15% will become $8,50,000. That is what the institute has done. So over here, there will be a depreciation of $1 million. There will be a depreciation of 0.9 or a depreciation of 0.85. Okay, this will give you profit before tax. 4 minus 1, that is equal to 3. 4.3 minus 0.9, 3.4. 4.55 minus 0.85, 3.7. Tax rate is 30%. So we are doing this in a way what institute has done. There could have been better framing, but at least from an exam perspective it comes. We'll quickly discuss this at the rate of 30%. So this will be tax at the rate 30%, and thereby we will get PAT, profit after tax. So this is 3 into 0.7, 2.1, 3.4 into 0.7, 2.38, 3.7 into 0.7, 2.59 plus depreciation 1, 0.9, 0.85, and this will finally give you cash flows 3.1, 2.38 plus 0.9, 3.28, 2.59 plus 0.85, 3.44. So this is 3.44. So let me just verify this at the end. If you go to see at the end of your RTP, you will have cash flows. The important thing over here is the cost 6, 5.7, 5.55, and depreciation 10, 9, and 8 lakh 50. Ultimately 31 lakhs, 3280, 3370. So let me just verify. 31 lakh, 3280. One second. Why is it different? Maybe I've taken a wrong calculation. Just a second. 3280 and last वाले में थोड़ा गड़बड़ है. Maybe I've done a wrong working somewhere. This is 4.45 होना चाहिए, I think. This is 4.45. 4.45 minus 0.85, 3.6, 3.6 minus 30%. ये शॉर्टकट करने में गड़बड़ हो जाता है. 2.52 plus 0.85, 3.37. Okay, and what are you required to find out? Annual cash flows after tax under all the three different scenarios of exchange rate. So this is 3.1, 3.28 and 3.37, and the expected value of cash flows, assuming no repatriation, expected value is probability based weighted average. So this is 3.1, 3.28 and 3.37. So if I look at this, 3.1 into 0.4 m plus 3.28 into again 0.4 m plus and 3.37 into 0.2 m plus MRC. So this is approximately 3.226 or 32 lakh 26,000. The viability of the investment proposal, assuming an initial investment of 25 million on plant and working capital, and the required rate of return is 11%. That is a discounting factor on investment, on the basis that cash flow arrived under option 2. So you have to take the expected cash flow as per option 2. Cash flow will grow at the rate of 3% per annum in perpetuity. So over here, the present value of future cash flow. So you want to find the NPV. For NPV, you need to do PVCI. Now what is your PVCI? Your cash inflow is going to be, if I take in million, 3.226 into 1.03 upon 0.11 minus 0.03. This is perpetuity based cash flow. 3.226 into 1.03 upon, let us say, 0.08 comes to, I believe, 41.53 million minus PVCO, which is 25 million as I mentioned over here, and hence the NPV will be around 16.53 positive. And since the NPV is positive 16.53, you should accept the project, at least as per what has been done by the institute over here. So these are the 2-3 questions which require a bit of contemplation. Other than that, there is some theory things, like over here in theory they say securities are created by dividing the cash flows associated with underlying securities of 2 and more. Explain the instruments and types. Over here they look at interest strip and principal strip, where you have a single bond and you split this into an interest only or interest strip, and then a principal only or principal strips, and then you evaluate based on that if you have to segregate. You can refer a separate theory video for this. Explain various techniques explicitly which do not involve transaction cost and can be used to offset the foreign exchange exposure completely or partially. Well, you can invoice in your own currency, or you can do netting, matching. All of these are various techniques that can be used for the purpose of meeting your foreign exchange risk without actually taking a forward future option where there is some transaction cost or bid and ask spread. So you can review the theory on this separately, but if you review the other questions, if I just quickly review the other questions, the first is a case study based MCQ where you have to find VAR, value at risk. In this value at risk, it's exactly same. I'm not, again, if you have not done this, you will have to review this, but it's exactly same. Even if you go to our VAR video, value at risk video, which is there on risk management revision, the same question is solved. It is not an MCQ, but the exact same question is solved, and based on that, all the 4 MCQs will be tackled. Okay. Then when you look at question number 4 over here, this is very similar to question number 36 on derivatives, where this is a binomial model, and within binomial model, this is the riskless hedge approach, because the question tells you that what is the perfect hedge that you should create, and you will solve based on that. This is same as the business valuation. I mean, this is in our book in mergers, question number 49. Again, it's very difficult to just discuss this, so I'm just kind of, if you have done this, you will know. If you have not done this, maybe then you know कि क्या आपको review करना है. So this is a fairly good question involving levered, unlevered beta. The only thing at the end is they've added one more point: compute the market value of KLM as per ABC. So this is not there in the institute or our material. Compute the market value of KLM as a part of ABC. So what they do is they take the earnings of KLM multiplied with the P ratio of ABC, and that is one way. Or you take the total value of ABC, that is total value of ABC, which is the current company, 80 lakh shares into 375, that is the total market cap, and then you split the market cap between KLM and other businesses of ABC in the ratio of the earnings. So this is the only point, see, which is different, though they have not given you adequate data for this. Point A and B was already done. Over here, question number 76 in this particular case is The forex question on operating exposure, transaction exposure, etc. Exactly same question. I think numbers are also the same. This is similar to a leading lagging question in foreign exchange 65. Advanced capital budgeting, exactly same or similar to question number 76, where you have to make a decision tree and then you have to make the entire NPV analysis based on that. Nothing new over here. This is arbitrage pricing theory. We have a question on Nirmal Kumar. Here you have Hari Kumar and certain other workings based on arbitrage pricing theory, multi-factor model, CAPM, etc. This is on bond valuation. This is on immunization. There are two bonds and you have to figure out that how do you create a portfolio which is immunized considering the both bonds, question 25 of the material. And this is on yield approach, question I think 58 of valuation, where you are having an expected yield, you compare it with the normal yield, make certain adjustments if required, and then find the value. This is question 11. This is question number 6 of mergers, where you have two companies and you are supposed to find the EPS, P ratio, growth, and then find appropriate exchange ratios. We are not, to be honest, I'm not discussing all of this. I'm just kind of running you through so that you are aware that this is there in your RTP and these are the things you have covered. You just need to review question number 3 and question number 13 separately based on what the institute has done, and that is sufficient. For further practice for interest rate management, you can even do question MCQ case study number 2. This is similar to I think question 4, question 20 or so of your interest rate management, but being an MCQ, maybe 2-3 other possibilities, it's good for practice. Net a manageable RTP, 2 new questions, theory questions in any case help you for a quick review, and that's about it. I'll see you soon with more such updates and videos. I hope you did enjoy this video. If yes, please do like, share it with your friends and subscribe to our channel if you have not already done. Means a lot to us. And keep studying, keep putting your effort, and put one foot forward of the other, and you will kind of reach your goal very soon. See you soon. Bye bye. Take care.